Assalamualaikum and hi everyone. Our group will present about the company analysis and stock valuation. The purpose of company analysis and stock valuations. It's convey the idea that the common stock of good companies are not automatically good investments. After analyzing a company and deriving an understanding of its strength and risk, we need to compute the intrinsic value of the firm's stock and compare its market value because to determine if the company's stock should be purchased. The stock of a wonderful firm with superior management and strong performance measured by current and future sales and earning growth can be priced so high that the intrinsic value of the stock is below the current market price. Lastly, the stock of a company with lower sales and earning growth may have a market price that is below its intrinsic value.
Growth companies and growth stocks. Growth companies historically consistently experience above average increases in sales and earnings, while theoretically yield rates of return greater than the firm's required rate of returns. Growth stocks is necessarily the stocks of growth companies. A growth stocks has a higher rate of return than other stocks with similar risk. Superior risk adjusted rate of return. Defensive companies and stock. Defensive companies is the firms whose future earnings are more likely to withstand an economic downturn. Defensive companies has low business risk, no excessive financial risk, and the typical examples are public utilities or grocery chains, firms that supply basic consumer necessities. Defense stocks are the rate of return is not expected to decline or decline. Cyclical companies and stocks. Cyclical companies are the companies whose sales and earnings will be heavily influenced by aggregate business activity. Examples would be firms in the steel, auto, or heavy machinery industries. Cyclical stocks will have greater changes in rate of return than the speculative companies and stocks. Speculative companies are the firm whose assets involve great risk but those that also have a possibility of great gain. A good example of speculative firm is one involved in oil exploration. Speculative stocks possess a high probability of low or negative rates of return and a low probability of normal or high rates of returns. Value versus growth investing. Growth stocks will have positive earnings, surprise and above average risk adjusted rates of return because the stocks are undervalued. Value stocks appear to be undervalued for reasons besides earnings growth potential. Value stocks usually have economic, industry, and structural links to company analysis. Company analysis is the final step in the top-down approach to investing. Macroeconomic analysis identifies industries expected to offer attractive returns in the expected future environment. Analysis of firms in selected industries concentrates economics and industry influences. If trends are favorable for an industry, the company analysis should focus on firms in that industry that are positioned to benefit from the economic trends. Firms with sales or earnings particularly sensitive to macroeconomic variables should also be considered. Research structural influences. Social trends, technology, political and regulatory influences can have significant influence on firms. Firms can grow and succeed despite unfavorable industry or economic condition due to demographic changes or shift in consumer tastes and lifestyle. Early stages in an industry's life cycle see changes in technology which follower may imitate and benefit from. There are two approaches to company analysis. The first one is the firm's overall strategic approach, which include industry competitive environment and SWOT analysis. The second one is the firm's valuation approaches, which is present value. Firm competitive strategies. Defensive strategy involves positioning firm so that its capabilities provide the best means to deflect the effect of competitive forces in the industry. Offensive strategy involves using the company's strength to affect the competitive industry. Porter suggests two major strategies. The first one is low-cost strategy. The firm seeks to be the low-cost producer and hence the cost leader in its industry. Cost advantage vary by industry and might include economies of scale, proprietary technology. The second one is the differentiation strategy. Firm positions itself as unique in the industry in an area that important to buyers. A company can attempt to differentiate itself based on its distribution system. Focusing a strategy. The first step is select segments in the industry. Then, tailor strategy to serve those specific groups. Next, determine which strategy a firm is pursuing and its success. And lastly,
Analysis. Internal analysis strength give the firm a comparative advantage in the marketplace. Perceived strength can include good customer service, high quality products, strong brand image, customer loyalty, innovative R&D, market leadership, or strong financial resources. Weaknesses. Weaknesses result when competitors have potentially exploitable advantage over the firm. External analysis opportunities. These are environmental factors that favor the firm. They may include a growing market for the firm's product, a shrinking competition, favorizing rate shift, or identification of a new market or product segment. Trade. There are environmental factors that can hinder the firm in achieving its goal. Example would include a slowing dynamic economy, additional government regulations, and increasing industry competition rate of entry, and etc. Several attributes of firm profitability. Firm product should not be famished. Firm also should have some long-run comparative advantage over its rival. Firm industry or product have market stability. Firm can benefit from cost reduction. Firm that can buy shares shows that they are putting monies into the firm. Of Warren Buffett. Business and is the business simple and understandable? Does the business have a consistent operating history? Does the business have favorable long-term prospect? As for management tenant, is the management rational? Is the management candid with its shareholder, or does the management resist the institutional imperative? Financial tenets focus on return on equity, not earning per share. Calculate the owner earning. Look for companies with high profit margin. For every dollar retained, make sure the company has created at least $1 of market value. As for market tenant, what is the value of the business? Can the business be purchased at a significant discount to its fundamental intrinsic value? Analysis. Internal analysis strength give the firm a comparative advantage in the marketplace. Perceived strength can include good customer service, high quality products, strong brand image, customer loyalty, innovative R&D, market leadership, or strong financial resources. Weaknesses. Weaknesses result when competitors have potentially exploitable advantage over the firm. Present value of dividend. Simplifying assumption help in estimating present value of future dividend. Below shows the formula for constant growth DDM as well as how to calculate the growth rate estimate.
The required rate of return estimate can be calculated using nominal risk-free interest rate, risk premium, as well as the market-based risk estimate from the firm characteristic line using regulations. The present value of dividend model requires investor required rate of return on the stock K to be more than dividend growth rate G. With dividend growth rate is more than investor required rate of return on the stock, analysis must use multi-stage model. The book have illustrated how to estimate a few stock experiences using three-stage model of DDM. Free cash flows to equity can be computed using net income plus depreciation expense minus capital expenditure minus changes in working capital minus principal debt repayment plus new debt issues. Below shows the constant growth formula. A multi-stage model similar to DDM can also be applied. Present value of operating free cash flow. Discounted from operating free cash flows to the firm FCFF at the firm weighted average cost of capital WACC. FCFF can be computed using earning before interest and taxes multiply 1 minus tax rate plus depreciations expense minus capital spending minus the changes in working capital and lastly minus the changes in other assets.
Now I am going to present about present value of operating free cash flow. The formula is firm value equals to FCFF1 divided by WSCC minus G FCFF or OFCF1 divided by WSCC minus G OFCF, where FCFF1 equals to the free cash flow in period 1, OFCF1, which is the firm's operating free cash flow in period 1, WSCC, the firm's weighted average cost of capital, GFCFF, the constant growth rate of free cash flow, and GOFCF, the constant growth rate of operating free cash flow. Besides, the formula for an alternative measure of long-run growth is G equals to RR multiplied by ROIC, where RR equals to the average retention rate and ROIC equals to EBIT in bracket 1 minus tax rate divided by total capital. As for the computation of WSCC, the formula is WSCC equals to WEK plus WDI, where WE is the proportion of equity in total capital, K equals to the after-tax cost of equity, WD is the proportion of debt in total capital, and I the after-tax cost of debt. Two-step process for estimating companies' earnings per share, which are sales forecast and estimated profit margin. Sales forecast includes an analysis of the relationship of company sales to various relevant economic series. It also includes a comparison with the industry series. As for the estimated profit margin, identification and evaluation of the firm's specific competitive strategy. It also needs the firm's internal performance and the firm relationship with its industry. As for Walgreen competitive strategy, the first one is the internal performance, which are industry factors, company performance, net profit margin estimate, computing earnings per share. The importance of quarterly estimates are a way to confirm our annual estimate. If the annual quarterly results are a surprise relative to our estimate, we will want to understand the reason for the surprise. Estimating company earnings multipliers. Estimating company earnings multipliers. There are macro analysis of the earning multipliers and micro analysis of the earning multipliers. which are comparing dividend payout ratios, estimating the required rate of return, estimating the expected growth rate, computing the earnings multiplier, and estimates of intrinsic value of Walgreens. Additional measures of relative value. The first one is price or book value ratio. Book value is a reasonable measure of value for firms that have consistent accounting practice. It can be applied to firms with negative earnings or cash flows. It should not attempt to use this ratio to compare firms with different levels of hard assets, for example, a heavy industrial firm and a service firm. Next is price or cash flow ratio. The price or cash flow ratio has grown in prominence and use because many observers contend that a firm's cash flow is less subject to manipulations. Next is price to sales ratio. Sales growth drives the growth of all subsequent earnings and cash flow, and sales is one of the purest numbers available. Next is analysis of growth companies. Generating rates of return greater than the firm's cost of capital is considered to be temporary. Earnings higher than the required rate of return are pure profit. The questions are, how long can they earn this excess profit, and is the stock properly valued? There are two types of growth companies and the DDM, which are no growth firms and long run growth model. So the first one is no growth firm. The formula for a no growth firm are negative E equals to R multiply assets, or negative E equals to R multiply assets equals to dividends. The formula for firm value is V equals to E divided by K equals to 1 minus B multiply E divided by K. The formula for required rate of return is K equals to E divided by V. There are 5 types of long-run growth models. The first one is simple growth model. It assumes the firm has growth investment opportunities that provide rates of return equal to R, where R is greater than K. The formula is R equals to MK, where M is the relative rate of return operator, and D equals to E, where 1 minus B. The formula for gross present value of growth investment is BEMK divided by K square equals to BEM divided by K. And the formula for net present value of growth investment is BEM divided by K minus BE divided by K. The formula for firm value is V equals to E divided by K plus BEM divided by K minus BE divided by K. The formula for present value of constant dividend plus present value of growth investment is V equals to D divided by K plus BEM divided by K. As for the formula of present value of constant earning plus present value of excess earnings from growth investment is V equals to E divided by K plus BE multiplied by M minus 1 and divided by K.
So next is expansion model. Expansion model assume a firm retain earning to reinvest but receive a rate of return on its investment that is equal to its cost of capital, which is M equal to 1. So R equal to K. The effect of such a change can be seen in the following equation, where the net present value of growth investment will be 0. Therefore, equation of expansion model will become V equal to E over K plus BE in bracket M minus 1 over K. Then the negative growth model. The negative growth model applied to a firm that retain earning and reinvest this fund in a project that generate rate of return below the firm cost of capital, which is R less than K or M less than 1. The earning of this firm will also increase if it earns any positive rate of return on the new asset. The important point is the earning will not grow as much as they should. So the value of the firm will decline over time when investors discount the below required cash flow from this reinvest stream at the firm cost of capital. Beside the capital gains component, this equation highlights the factors that influence the capital gains component. Beginning with this equation, all the equations suggest that the gross present value of growth investment is equal to BEM over K. This critical time factor often is overlooked because we are typically assume an infinity horizon to simplify this equation. However, when analyzing growth company in the real world, the time estimate is clearly a major consideration. In summary, the three factors that influence the capital gains component are: first, the amount of capital invested in growth investment, which is B; second, the, the relative rate of return earning on the fund retained, which is B; and last, the time period of this growth investment, which is K. So next is dynamic true growth model. A dynamic true growth model applies to a firm that invests a constant percentage of current earning in a project that generates rate of return above the firm required rate, which is R is more than K and more than 1. Given this assumption, the dynamic growth model for an infinity time period is the dividend discount model derived in the appendix to an introduction to security valuation. The formula for dynamic true growth model is V equal to D1 over K minus G. Measure of value added. Economic value added, which is EVA, is the preceding calculation provide a positive or negative dollar value which indicate whether the firm earned an assets above its cost of capital during the year analyzed. EVA extends this concept to evaluate the annual performance of management by comparing the firm net operating profit less adjusted taxes (NOPEX) to the firm total cost of capital in dollar terms, including the cost of equity. So next is EVA return on capital, which is the formula is EVA divided by the capital. This ratio can help you to compare firms of different size and determine which firm has the largest economic profit per dollar of capital. The alternative measure of EVA is an alternative but equal way to measure and think about EVA is to compare directly to the firm return on capital employed to the firm average cost of capital, which for example WACC. Next is market value added (MVA). In contrast to EVA, which generally is an evaluation of internal performance, MVA is a measure of external performance, which is it's determined on how the market has evaluated the firm performance in the term of the market value of debt and market value of equity compared to the capital invested in the firm. So the relationship between EVA and MVA. EVA does an outstanding job of evaluating management past performance in the term of adding value, while one would certainly hope that superior past performance will come. So there is nothing certain about this relationship. Then the franchise factor. The franchise factor concept is similar to EVA since it is recognized to add value to a firm. It is necessary to invest in projects that provide excess MVP. That is, the firm must generate rate of return above its WACC. This tactic is directly related to the valuation approach we have been using since the franchise value approach breaks a firm observed PE ratio
down into two components. So the component number one is the PE that is based on the company outgoing business, and the second is a Frenchy PE that the market assigned to the expected value of new and profitability business opportunity. This can be visually as equal to Frenchy's factor time by growth factor. Growth duration model. The purpose of the growth duration model is to help you to evaluate the high PE ratio for the stock of a growth company by relating its PE ratio to the firm rate of growth and duration of growth. A stock PE ratio is function of, first, the firm expected rate of growth of earning per share, second, the stock required rate of return, and third, the firm dividend payout ratio. The growth estimate must consider both the rate of growth and how long this growth rate can be sustained. That is, the duration of the expected growth rate. Intra-industry analysis. The technique probably is the most useful for helping spot overvalue growth company with a very high multiplier. In such a case, the technique will highlight that the company must continue to grow at some very high rate for an extended period of time to justify its high PE ratio, for example, duration of 15 to 20 years. And also, it can help you to decide between two growth companies in the same industry by comparing each to the market, to the industry, or directly to each other. Such a comparison has provided interesting insight wherein the new firm in an industry will grow faster than the larger competitor, but their PE ratio is substantially higher and imply that this new firm had to maintain this larger growth rate superiority for over 10 years to justify the much higher PE ratio.
There are 5 types of long-run growth models. The first one is simple growth model. It assumes the firm has growth investment opportunities that provide rates of return equal to R, where R is greater than K. The formula is R equals to MK, where M is the relative rate of return operator, and D equals to E, where 1 minus B. The formula for gross present value of growth investment is BEMK divided by K square equals to BEM divided by K. And the formula for net present value of growth investment is BEM divided by K minus BE divided by K. The formula for firm value is V equals to E divided by K plus BEM divided.
So when come to sell, first, holding a stock too long may lead to the lower return than expected. Second, if stock decline right after purchase, is that a further buying opportunity or an indication for incorrect analysis? Third, continuously monitor key assumption. Fourth, evaluate closely when market value approach estimate intrinsic value. Last, know why you bought it and watch for that to change. Influence on analysts. First, efficient market. In most instances, the value estimate for a stock will be very close to its market price, which indicate that is proper value. Second, paralysis of analysts. To earn above average return, there are two requirements. First, the analyst must have expected that differ from the consensus. And second, the analyst must be correct. Last, analyze conflict of interest. A potential conflict can arise if communication occurs between firm, investment banking, and equity research division. Global company and stock analysis. A major goal of this text is to demonstrate investment technique that can be applied globally to market, industry, and company around the world. While space constraints do not allow a full demonstration to internal firms, it is important to point out some of the major factors and constraints that analysts and portfolio managers need to acknowledge and adjust for when investing globally, such as inavailability of data, differential account convention, currency differences, political risk, transaction costs and liquidity, and last, valuation differences. So thank you for viewing our video and pay attention on it. For any question you may ask on the WhatsApp group and have a nice day.